Kicking off the show with Citigroup Stuart Kaiser, Jim Bianco of Bianco Research. Jim, great to catch up with you as well, Stuart. Jim, I want to start here on the Federal Reserve. Rate hikes on ice. Is that what they're going to say?
I think so. I think that they're going to probably pause at the September meeting because the market is giving you less than a 10% odds. But the question will become the November meeting because those are a lot closer to 50-50, and we'll have to see how the data plays out from there.
Stu, is that the Citi view as well?
Yeah, Jonathan, good morning. I think the base case is just that they'll pause in September, but they're going to want to keep November in play, just because they're going to want to respect the fact that they don't know how data is going to come in, and I think they want the market to just not price them as completely done with the cycle. So, yeah, pause in September and keep November kind of on the table just in case.
Bond market yields high this morning, 10-year up by 4 basis points, right now 422, 2-year up by a couple of basis points to about 489 or so. Jim, I'm struggling with the consensus view coming into September in this bond market at the moment. What is that consensus view now?
I think the consensus view is bullish. A lot of people are looking for a recession. They think that the inflation problem has been vanquished. They're looking at the data, and they're seeing in the futures market a big short position, but that's probably a basis trade. And once you've taken that out and you look at positioning or you look at economist opinions, they're all kind of looking for rates to fall, and the contrarian play would be a further rate hike, or further rate rise, excuse me.
So sticky inflation, no cuts, stronger growth. Contributing to that, Jim, maybe this headline, just dropping across the Bloomberg, excusing me for being distracted, Saudi to extend voluntary cuts of 1 million barrels a day until December, the end of December 2023. Looking at the oil market right now, 5-day rally coming into today. Crude with a pop, 89.64, just short of 90 here on Brent crude, up by 0.75%. Jim, a word on crude. Is that a reflection of a better demand backdrop, or is that just the supply story playing out?
Well, I think it's more of a demand story because you got to keep in mind since late June, crude oil prices are up more than 27% right now. Gasoline prices haven't caught up with it, and they probably will. When you see a big move like that, and yes, I know the Saudis have been voluntarily cutting. They've extended their cuts, but those have been in place for months. It's more consistent with a strong Atlanta Fed GDP and strong data and downgrading the probabilities of a recession because people are consuming energy because the economy is moving forward. I think that will continue to be the case. In other words, crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
New highs for the year on crude right now, just short of 90. It's the South rally, Stuart Kaiser, hardly anybody's talking about. What do you make of it?
Look, I think our view here is essentially what Jim described, which is economic data continues to come in strong, and that's pushed cyclical assets, higher and also pushed yields higher. I think the big risk here is, as we've talked about in the past, Jonathan, is that expectations have gotten a little bit more stretched, and the reaction function of equity markets to that data and actually to the rise in yields have become a little bit more troublesome. So, as a base case here, we're still relatively positive on the markets. Strong labor market, easing inflation, but there's definitely some fraying around the edges that I think you need to respect.
Well, Stuart, to build on that, this was a rally so far year to date that has been built on top of upside surprises. Economic data coming in better than expectations. Can you make the same argument that we can build a rally on a series of downside surprises?
That would not be our view. Look, we believe equities are a nominal growth asset, and I think if you start to see disappointing economic data, you don't want to step in front of that. You want to let that weakness happen, and you want to buy at a lower level. So I think from my perspective, I agree with you. I think positive economic growth surprise is what's driven the market higher this year, and that works in both directions. And if the nominal growth starts to weaken, I don't think that's something that you want to trade to the upside from an equity perspective.
Here's another headline, 2 in the last couple of minutes. If you are just tuning in, let's get up to speed together on the commodity market at the moment. The first headline from the Saudis to extend voluntary cuts of 1 million barrels a day until the end of December 2023. The second headline, this one from Russia, to expend a 300,000 barrel a day oil export cuts through December. They're trying to support the crude market. Jim, I'm going to throw in iron ore as well. So crude at new highs for the year. Iron ore at highs we haven't seen since maybe April. This all happening with a slowdown developing in China. Jim, what's the signal you take from that?
Look, I think when you look at the broad commodity markets as they move higher, especially in the industrial metals where iron ore is and in energy, The takeaway is that the economic strength, or the nominal growth in the economy globally, is stronger than people think. Yes, China is slowing down, but it seems like the rest of the world, even though we keep talking about recession and slowdown, seems to be compensating for that, and that's why you're seeing higher commodity prices. And if we are seeing higher commodity prices, eventually that should translate into higher yields. Again, as we talked about earlier, at the same time when everybody's positioning themselves for a fall in interest rates.
Well, right now it's fueling higher crude prices through 90 on Brent. Brent crude at $90 a barrel, up by more than 1% on a session. WTI crude just short of 87 here at 86.99. Turns through 87 briefly, up by 1.8%. Jim, let's stay on top of this oil story. Have we seen enough from China? Enough from China, from your perspective, to suggest they can put a floor under this growth risk now?
Not yet. I think that the Chinese have really got problems with their property market, and they've got other issues they have to deal with before we start to say that there's a floor there. Now, maybe it's priced in their financial markets might bottom, but their economy won't. And let's keep in mind what extraordinarily is happening there. They reopened after zero COVID in January. And yet it might wind up being that this year is the same growth or worse than the year that they were welding people into their houses last year, which is an incredible statement to say on its own. And it underlies the big problems that the Chinese economy has, which is why I don't think I've seen enough to say that they've got a handle on it. And it isn't just that they need a couple of more basis points cut from the central bank in order to spur growth. It's much more structural than that.
Stuart, how does what happens in China shape your view of what happens here?
Look, it definitely matters. I think the narrative around China and the impact on U.S. equities has shifted over the last month. Initially it was China's exporting deflation, and that's going to be positive. It's going to help the Fed. I think the discussion has frankly shifted to something that's more about a negative growth impulse and potential event risk coming out of China. So I think it does create a headwind from a growth perspective. Obviously also impacts European equities, particularly German exporters and luxury good manufacturers. So there's definitely an impact, and I think the narrative around it has shifted much more negative over the course of the last month or so.
It's certainly amazing to see growth in China disappoint, coming much, much lower than expected in 2023 relative to expectations of 9 months or so ago at the start of this year. And see crude back with a 90 handle on Brent. That's the latest for you this morning. Two headlines, one from Saudi, one from Russia. Saudi Arabia to extend voluntary cuts of 1 million barrels a day until the end of December 2023. Throw in Russia to extend 300 barrels a day oil export cuts through December. And you've got the recipe for a higher oil price right here, through 90 for the first time since November. That is a new high for 2023. Crude right now, Brent up by 1.3%, WTI up by 1.9%. To Jim Bianco's point on the bond market, fueling maybe some upside in yields here. Treasuries down, yields up by 5 basis points on a 10-year 4.22. Levels we've seen through much of this morning, up by 2 basis points on a 2-year, up to about 4.90 on a 2-year yield right now. Jim and Stuart are going to be sticking with us. Let's get you some movers elsewhere, with equity futures still just about negative by 0.1%. Here's Simone Foxman.
Yeah, John, equity futures may be looking negative, but Airbnb shares are rallying after it was announced that it would be included in the S&P 500 index as of September 18th, that along with Blackstone. And this really highlights the importance of passive index funds, because as we speak, the local law 18 in New York City is going into effect, and that severely limits the company's operations, but we see shares still up over 6% in the pre-market. Also watching shares of Nikola, there were local news reports of a semi-truck fire at Arizona lithium facility in Tempe last night. There were no injuries reported, but there have been a lot of concerns about the possibility that there are battery problems that cause fires in Nikola's electric trucks. We're also closely watching Warner Brothers Discovery. We're not seeing a big movement at the moment right now, but we're the company guiding lower adjusted EBITDA for the full year after a $300 to $500 million hit from the impact of these strikes. That despite the fact that Barbie has become the best grossing movie worldwide this year, John.
More from Simone around the opening bell. That opening bell about 20 minutes away. The latest in the oil market, 6-day rally on Brent crude, up another 1% today, briefly through 90, just about there right now. $90 a barrel for the first time since November, as the Saudis and the Russians keep pulling back. Coming up, President Biden making his Labor Day pitch.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union.
Latest from Anne-Marie. Up next.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor. They don't say union. It's union. I'm one of them. I'm proud to say union. I'm proud to be the most pro-union president, according to the experts about in American history. And by the way, I make no bones about that.
The president attempted to shore up ties with labour unions in Pennsylvania, downplaying the threat of a potential auto strike, telling reporters, quote, "I don't think it's going to happen." The contentious negotiations leaving an opening for Republican frontrunner Donald Trump.
What's happening to our auto workers is an absolute disgrace and an outrage beyond belief. Both the UAW bosses and the big three auto executives should be screaming at the top of their lungs. They should be ashamed of themselves, demanding that Joe Biden cancel his brutal electric vehicle mandate before it destroys the entire U.S. auto sector. To every auto worker, I stand in total solidarity with you in your fight against Joe Biden's job-killing Green New Deal insanity.
Donald Trump on the offensive as voters overwhelmingly think President Biden is too old to run for re-election and giving him low marks for his handling of the economy, according to a new Wall Street Journal poll out in the last couple of days. Bloomberg's AMH joined us from Washington, D.C. Anne-Marie, who's going to win that battle for those unions?
Well, for the UAW, Jonathan, at the moment, it's still up for grabs in the sense that they have not come out and endorsed anyone. And they've said that people in Washington need to take note about what is going on. If they want our endorsement, they need to be there for us. So that is something you see the former president, Donald Trump, try to tap into. He was out with a Truth Social post yesterday about this, saying there's an EV glut and UAW should not be backing the Biden administration. We should note the UAW did back Biden in the last round. They likely will lean towards the Democrats, but they're probably just using this endorsement as leverage at the moment, the same way they're using a strike as leverage at the moment, as they are up against the three big auto companies. And Jonathan, that contract expires September 14th. And when you heard from President Biden yesterday, is that when he said he didn't think there would be a strike, Sean Fain, the UAW president, came out and said he must have more information than we do.
AMH, the president says he's the most pro-union president ever in the history of the United States. I have no idea what that means. Isn't this the most easy time to be the most pro-union president of the United States, given where union membership is relative to where it was decades ago?
That is true. Relative to decades ago, if you look at the 1970s, an organization like UAW had more than 1 million workers. Right now, it's a few 100,000. But at the same time, the president does want to make sure that he is talking about labor unions. He talks about the fact that he's a son of Scranton. This is where he was talking on Labor Day in Pennsylvania. This is something he wants to lead into. His biggest issue, though, Jonathan, is one of the biggest gripes the UAW has is with the electric vehicles. When you see this administration come out and talk about loans or subsidies or grants for companies to build battery plants, the UAW, they do not have kind words for this administration.
His biggest issue this morning is in the oil market. Anne-Marie, let's go there. Two headlines in the last 10 minutes or so. One from Saudi Arabia, one from Russia. The message pretty clear. We're not going to stop pulling back anytime soon. How do you think this White House responds to that?
Well, Jonathan, this kind of goes to their industrial policy of wanting to electrify the grid. They wouldn't have to worry as much about what Saudi Arabia was doing. What we're seeing from the Saudis is that it's prolonged this cut. We didn't think it was going to be this long, and that's why you see Brent prices spiking above $90 a barrel. The administration was already concerned with gasoline prices. They're nowhere near they were last summer when they hit above $5 a gallon, but they are trending towards $4 a gallon. That will be very difficult for this administration. That is still dealing with inflation. Yes, the rate of inflation is slowing, but they're still dealing with inflation. This continues to show up in polls, and it's why the Americans give the Biden administration poor marks on the economy.
$90 Brent right now on the screen at 1.5%. AMH, thank you. Anne-Marie with the latest down in Washington, D.C. Some final thoughts from Stuart, Kaiser, Jim Bianco. Jim, let's pick up on that crude story. Crude right now at 1.5%. September 20th, the Federal Reserve. We can work backwards. September 13th is CPI. Jim, some upside risk to the inflation story into year-end from your perspective?
Yeah, I think on two levels. On first level is that September of last year was a small number. It was 0.2. We're looking for somewhere between 0.6 and 0.8 for this month. In other words, a base effect that can push year-over-year inflation up to 3.7 or 3.8. And if you extend that through the rest of the year, it really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4. Now, that's not catastrophic, but it's certainly not the type of number that's going to get the Fed to be talking about 4 rate cuts next year if we end the year at 4% inflation.
Stuart, how would you expect equities to trade around that kind of story? If Jim's right, what kind of price action would you be looking for?
Yeah, I mean, our view is pretty similar, is that you probably saw the 2 weakest prints you're going to see this year over the summer, and, potentially, A, some upside risk, and B, you're probably just also going to tick higher relative to those very low numbers. My view here is as long as inflation volatility remains relatively well contained and you're kind of in a slowly easing or grinding lower type inflation environment, equities should be okay. If you saw something like 0.6, 0.8 and inflation actually hooked higher, obviously the market would have to price that risk a little bit, but big picture, inflation volatility's come down. The rate of inflation has sort of stabilized a bit, and I think what equity markets want is clarity and certainty. So if you have sort of stable inflation, stable jobs, I think equity markets can handle that pretty well.
Stuart, over the weekend I was reading through it. You gave a base case, a tactical view, and a contingency plan. Stuart, can you go through that for us now?
Yeah, sure. Our base case, as I mentioned, is, job market remains pretty solid. Inflation is easing, but a little bit sticky. And I think, that allows equity markets to work, probably with, not the type of velocity we saw earlier this year. Tactically, we do like hedging markets. There is the chance here that inflation does tick higher. You're running to the show, mentioned seasonality a few times. So that's obviously a risk in the background. China, higher rates, market technicals, options flows. There's a lot of tactical reasons, I think, to be a little bit careful. And we do like hedging through till the end of the quarter. The contingency, though, I think is the key thing here. It's what could really disrupt this rally. And we've put 3 things out there, but number 1 on that list is U.S. labor markets. And I do think if you see U.S. labor markets continue to start to weaken, meaningfully, then you are going to see equity markets trade lower. Our view is you don't want to step in front of that. You don't want to buy the first sign of weakness. You kind of want to let that weakness play out. So the contingency for the markets here is the strength we saw in the labor market on Friday, doesn't get repeated. Labor market and services sector comes under pressure, and I think that's your bigger downside risk. Hedging-wise, we would focus on U.S. retailers as a way to play that story. In
other words, Stuart, bad news is just bad news.
Always. They wouldn't call it bad otherwise, right? They would call it good if it was good.
Jim, you on the same page?
Yeah, I am. I think that definitely on the page that, bad news might wind up becoming bad news as we move forward from here. But I think that when you look at the labor market, I want to go back to what you and Anne-Marie were talking about. The labor situation, especially among unions, which is only 6% of the labor force, is getting to be very substantial. I think one of the things the UAW is looking at is a 32-hour work week, a 4-day work week. They want to go hybrid like everybody else does. And these are intractable problems. So the labor market could give us quite a bit of volatility as we move forward, unless there is some kind of a deal. And then you've got potentially a transit worker strike in New York City coming right after that for the same reasons.
Sign me up, Jim, not for the strike, but for the 32-hour work week. Now, Jim, you mentioned the union membership and how low it is, particularly relative to where it was several decades ago. You can make the argument that maybe these negotiations are meaningless for the overall labour market. Do you think there's a signal effect here, though, Jim, that we all see those headlines, we get to year end and we say, you know what, I'll have some of that as well?
Oh, yeah. I think it all started with the UPS workers getting $170,000 a year to deliver packages, that is reverberating through not only the West Coast port, but, the UAW and the transit workers and everybody else is saying, I want to get some. And, yeah, you're right. 94% of the workforce is not unionized, but that 6% is. If they walk out on strike, like the Hollywood writers' strike, another one, it can be very disruptive for the economy as we go forward.
I'll form a union for the 3 of us, guys. 32-hour work weeks coming up. Jim Bianco, Stuart Kaiser, to the both of you. Thank you, guys. Going into the opening.